What's up traders, Tom here with another video. Today we will be discussing the current state of the stock market for the week ahead and our technical analysis thoughts for the S&P 500, the volatility index and the Russell 2000. What signs are these charts showing us? Stay tuned. So we'll begin today by talking about the catalysts for this current market pullback. One of them for sure is that the crisis is coming back, as in the virus is spreading. If we're taking a look at what the news has been over the weekend, we now see Tokyo has new reported cases, Iran has new reported cases, Florida has big spikes, and this is all on Bloomberg's front page right now. Also, Beijing had a breakout and they've now quarantined certain areas and shut them down. So we are seeing a resurgence in numbers, and this is sure to be spooking the market. One of the clear kind of signs on the weekend when we're not seeing trade is to potentially look at weekend futures. We have here IG's weekend Wall Street futures, and I was watching these pretty closely during the March crash. In fact, during the March crash, you were seeing these futures going as low as about 4 to 5% over the weekend, and they were pretty much tracking the open. We'd probably say they were only about 0.5% to 1% wrong on the open tick when the real futures opened on the Monday. So right now we've actually seen a further 1% decline over the weekend, but I think what's more alarming is this sentiment change here. So last week, you would not have seen any percentage of retail clients, because remember, everyone that's trading here is a retail client, going long. They were all shorting the market and they were all getting their stops taken out by the people of Wall Street and the market movers. Now we're seeing 55% of clients long the market. So effectively, the sentiment has changed in just a few short days. And while I'm pretty bullish on the idea of buying dips and buying quality stocks, I'm not that bullish on buying pure indices over the longer term. I like to pick and choose right now because we're in a very strange time. So the sentiment has changed, and it's changed in just a few short days, and we're going to see how that's playing out. So a lot of people are blaming day traders for the rising stock market, but really it's day traders with Wall Street playing behind. They know what's going on. They see the flows. They're very well aware. What's happened though is we're now seeing so much participation in the markets that you are seeing pretty much as high as it's ever been, if not the highest it's ever been in 18 years. So market participation is incredibly high from retail traders, and most of these retail traders haven't taken significant losses ever. So Citi is now claiming that the downturn in the next year is now being ranked at over 70%, and they'd be using that based on their Citigroup panic euphoria model. And if you're not aware of this, it's worthwhile checking out if you can get the actual stats on it. It's often in newspapers and other editorial areas. So basically, during the month of March, this particular sentiment euphoria indicator went all the way down, of course, to panic. And then very quickly through April into May went to euphoria. And it's one of the quickest switches you've ever seen in terms of massive switch from panic to euphoria. And we saw that in the markets with the recovery. So to have a euphoria this high usually means the market is definitely topping out. And that's why, of course, we're talking about this today. But the sentiment has changed, and it's going to change again relatively quickly, I would think. So now let's just quickly talk about the S&P 500 before getting into the technical analysis. And I want to just draw a conclusion between S&P 500 versus corporate profits after tax over time. We're going to highlight two things. We're going to highlight before the tech bust, and then we're going to highlight the second point, which is where we are now. So for a long time, you would think stocks are going to be relatively valued on things like corporate profits. Now, they were for a very long time, as we can see here. Then it kind of decoupled into the tech boom. Then it got back. And actually, after the GFC, you were seeing corporate profits, very strong corporate profits, yet the index was actually a lot lower. So people had a lot of fear and they weren't prepared to get into the market. What is more alarming, though, is what we've seen recently, which is a huge decoupling of profits versus, of course, the market itself. And there's a myriad of reasons why this has happened. But if we look at where corporate profits are now and the disparity, I don't think it's ever been this big in terms of disparity. And it is something that we'll want to cover on this channel and cover in general over time. So make sure you subscribe and hit that bell if you've been enjoying our content and if you want to see more of these things in the future. So let's just quickly talk about the VIX. I've seen a few other YouTubers and other people commenting about the VIX. So has the VIX spiked? Of course. We've seen uncertainty come back into the market. Now, a lot of people are drawing parallels between this VIX spike and the VIX spikes of 2008. And if you actually look at the market did spike, and over that period of time, so if we look here from 2008, December, we did see a spike and it remained relatively high to March. So let's actually take a quick look at what happened with the market over that time. So here we have December in 2008, we saw that sell-off. Then we had a sell-off into March. So there was a significant second kind of little downturn here before the recovery was in. And that could be what we see in the stock market now. Even though the Fed has underpinned a certain value or a certain concept in the S&P, it doesn't mean that we are now seeing the absolute lowest point that the S&P is going to hit. Before we continue talking about the S&P, I want to just always go back to the Russell 2000. And I think that's just because I want to talk about the real economy as much as possible. We have a decoupling between the real economy and unemployment and, of course, the stock markets right now. And there's a whole bunch of reasons that we've covered on this channel, and definitely watch some of our backlog to see what we've been talking about. But we do have an engulfing candle here on the weekly, and this is pretty bearish sign for the Russell 2000. And remember, the Russell 2000 is the smaller companies. So these are the ones that are more susceptible to the problems of bankruptcy, to the problems of cash flow. So the market got back up and has pretty much tested that green line, which is the 200 simple moving average. We've got a bearish engulfing weekly, which are relatively strong candles. Whenever you see these kind of bearish engulfing, they're often followed by at least one other bearish engulfing candle, just like over here on the left. A nice big one, followed by another nice big one. So with the weekend futures trading lower, with the news of the second wave coming out in other parts of society, and of course, America continuing to have problems with this current crisis, it could state for further shorting over the next week. So let's go back to our S&P 500, take a look at that, and then talk about what we would usually want to see from a perspective of technical analysis to see a change in sentiment. So one of the things you want to see whenever you're trading and you're looking for a change of trend is you really want to see a sequence like this, where you've got basically your peak, you've got a trough, you've got a lower peak, and then you have a break of that trough forming a lower trough. So when it forms a lower trough, what that means is it's had a simple change of trend on the time frame, and it signifies that momentum is going that direction, but more importantly, the market has thought about the process. It's important as well because this is definitely a key level. This 2950 into 3000 is where we have a 200 moving average on the daily. We have previous resistance acting as support, which is something called role reversal, which if you aren't familiar with that, you definitely need to learn that as a support resistance price action trader. Very important you understand that. And if it gets through that zone, I really think it exposes this 2800 kind of area down here. And that could happen relatively quickly. In a video, we were talking about how 3000 was going to be the first level of support, and it gapped down there in one day. That's how fast it can happen. So when it gets through, and if it does something like what we've got drawn on the screen, you would generally see the market go back to 2800. I think there'll be some buying support there, but that's still a significant discount to even where the price is right now. Now, if it gets through 2800, you are seeing a significant change of trend. And then you are talking about potentially getting as low as the 2400s and previous lows. So 2800 will be a big fight between the bulls and the bears. If it can get through like this is the change of trend you're looking for. You don't ever want to just think that a flash crash is the end and that means that the bear market started. It generally does something like what we're seeing on this chart. Well, that's at least the way that you want to be doing it, with more statistical chance that you're making the right decision. I think the Russell is showing traders the way though. The Russell is showing that there's weakness in the back end of the market. It is an engulfing pattern and it looks pretty weak moving into the new week of the market. So if you're wondering what you do about a market like this, well, one of the things you can do is you pick companies you believe in. We actually made a video about the top 10 companies that we're looking at, or at least 10 that we are looking at in general. So do check that out. And always have a plan for these scenarios. Look how fast the market moved last week. We always want to have a plan so that we can enact on that plan. Just because you have knowledge of something, if you have knowledge and you cannot act on that knowledge, then there's no real point having that knowledge. And I find a lot of people have trading paralysis or investing paralysis the more information they get. So always follow kind of a simple method, follow a simple concept, and that usually will help you out. So we're thinking of an idea where basically we're going to take all of the ad revenue ever earned on this channel, disclose that ad revenue, and then invest that ad revenue into a series of different investments, and every month we'll add to it with the community. The idea is to show people what can be done when you compound and you dollar cost average into quality investments. And then on top of that, we want to donate a significant portion of that money to charities that the community decides. If you like that idea, let us know down below, but we are planning it. We haven't announced it yet fully, but it's something that we're thinking about doing. So if you like it, let us know and we will consider doing that in the future. Happy trading, everybody. Remember to subscribe, hit the bell, give this video a like and comment down below, and we'll see you in the next video. Happy trading and have a great rest of the weekend. Bye.